Good morning, everyone, and welcome to Tronconi Segura & Associates 2020 Tax Year-End Update webinar. I'm your host, Tom Mazurek, a partner in the firm's state and local tax practice and one of the co-leaders of our COVID-19 response team. This is the third and final webinar in our series of year-end updates. Recordings of our prior update webinars on COVID-19 and accounting are posted on our firm's YouTube page, as this webinar will be later today. Before we begin, I want to point out the menu bar that should be in the top right of your screen. You can click here to manage your audio options, ask a question, or download a PDF copy of today's slides in the handout section. The federal government's response to the coronavirus pandemic has been unprecedented in its effort to help businesses and individuals recover from the worst financial crisis since the Great Depression. Congress has already passed 4 large spending packages for the government to use for pandemic relief in 2020, and hopefully one more is in the works. In addition to providing roughly $2.6 trillion in new budgetary resources for federal agencies to respond to the pandemic, this legislation, primarily the $2 trillion CARES Act, included provisions for the federal government to defer and reduce taxes to provide relief to millions of Americans. The Congressional Budget Office estimates the 2-year impact of these provisions to be over $900 billion in tax relief. Joining me this morning are Stefan Swinar and Lisa Merkel. Stefan is a tax manager and Lisa is a principal in our small business practice, and they will highlight and discuss the key business and individual tax provisions originating from the pandemic relief legislation. Lisa will also provide us with a quick update on the Affordable Care Act. Also joining me this morning is Diane Straka. Diane is one of the partners in our small business practice, and she, along with Lisa, are going to help you get a jump start on preparing for your 2020 tax filings, discussing certain documentation we're going to be looking for from our tax clients related to these provisions this busy season, which will hopefully end in April next year and not be extended again. Last but certainly not least is John Callahan, a partner in our tax practice. John is going to preview and share with us some of the key tenets of President-elect Biden's tax plan, as many taxpayers have questions about what tax changes may be coming in the next 4 years. One final note before I hand things off to Stefan to get us started. If you would like to get CPE credit for attending this webinar, you need to be online for at least 15 minutes of the program, respond to 3 of the 4 polling questions, and complete the survey following the webinar. I'd like to welcome Stefan now to start us off.
Thanks, Tom. As you noted, I will be touching upon 2020 tax developments related to businesses. A majority of these changes and provisions were implemented in the CARES Act, passed earlier this year in response to the COVID-19 pandemic. These changes were put in place to provide financial relief to businesses in addition to incentivize businesses to retain their employees during the pandemic. I will be touching upon the following areas: net operating losses, excess business losses, the business interest deduction limitation, qualified improvement property, the charitable contribution limitation, discharged SBA loans, economic injury disaster loans, or the EIDL, the employee retention payroll tax credit, tax credits for paid sick leave and family leave, and expiring tax provisions in 2020. Next slide, please, Tom. One of the major provisions in the CARES Act was the change to the net operating loss rules. Prior to the Tax Cuts and Jobs Act was implemented, NOLs were allowed a carryback period of 2 tax years or a carry forward of 20 tax years. However, this was eliminated, or the TCJA eliminated the ability to carry back NOLs after 2017 tax years and changed the carry forward period to an indefinite period. Additionally, net operating losses are now limited to 80% of a business's taxable income for the year. The CARES Act implemented some taxpayer-friendly changes to the net operating loss rules. For NOLs that were incurred under tax years 2018, 2019, and 2020, these losses are eligible to be carried back to the preceding 5 tax periods to offset taxable incomes in those years. This will be very beneficial to taxpayers that may be having a down year in 2020 due to the pandemic. It will allow the recuperation of previously paid tax dollars and allow for a quicker influx of cash rather than waiting to use the losses in future tax years. This is also very beneficial because the corporate tax rate decreased from a max rate of 35% to 21% in 2018, allowing for losses that were incurred at a 21% tax rate to be carried back to a 35% tax rate, allowing for a recuperation of 14% of tax. For taxpayers that have already filed their 2018 and 2019 tax returns and have yet to take advantage of these rules, amended tax returns may be filed in order to claim the NOL carryback and get cash back as soon as possible. Next slide, Tom. Next are the changes to the excess business losses. Under the TCJA, non-corporate taxpayers are not allowed to claim a deduction for excess business losses for tax years beginning after December 31, 2017. Any disallowed loss is added to the taxpayer's NOL carry forward for future tax years. A non-corporate taxpayer is any taxpayer that finds a Schedule C as a sole proprietor, capital gains losses that may have been incurred during business activities, gain losses on the sale of business property, partners in a partnership, and S corporation shareholders, Schedule F filers, which are mainly farmers, and the activity of being an employee. The calculation is a gross receipts threshold versus deduction test used to determine the loss allowed in a given tax year. Under the CARES Act, the excess business loss rules have been suspended for the tax years 2018, 2019, and 2020. As with the NOL carryback changes, taxpayers that have filed the 2018 and 2019 returns that may have been subject to these losses have the ability to amend their returns to allow the loss for the year and get back additional tax dollars. Next, please. Next, I'm going to talk about the business interest deduction limitation. This is a limitation that all businesses are subject to, but they may not know that they are actually subject to. It's a fairly complicated calculation that limits interest expense during a tax year. The interest is limited by factors such as non-investment income interest, floor plan financing interest, and 30% of what is called adjusted taxable income, or ATI. Under the CARES Act, the ATI limitation has been increased from 30% to 50%, allowing for more interest to be deducted in a current year. Additionally, if a business's ATI was higher in 2019 than it is in 2020 due to a down year, an election can be made to use the 2019 ATI to give a higher threshold for the allowance of deduction in 2020. There is also a small business exception to this calculation, which is a 3-year average gross receipts test. If a taxpayer is under 3 years average gross receipts of 26 million, then this limitation is not applicable and this calculation does not have to be done. Again, this is another change to the tax law that is done to allow businesses a higher income or interest deduction for the year and hope to lower income that is being taxed in 2020. Next. Next, we're going to talk about qualified improvement property. QIP is defined as internal improvements to non-residential real property. These improvements do not include any improvements to internal structural framework or an enlargement of any building. The main items included under this new classification of asset will be improvements and renovation to the inside of any building. A common example of these would be a major renovation to the inside of a taxpayer's building, including the construction of non-load bearing walls and other cosmetic updates. The importance of this new classification is that they are no longer to be capitalized and depreciated over a 39-year period. The QIP are assigned a 15-year tax life, and most importantly, they are eligible for bonus depreciation. This allows for the acceleration of depreciation deductions in the current year that the asset is placed in service, allowing for a taxpayer to receive the tax benefit in the year the asset is in service rather than over the long 15-year tax depreciation life. Next slide, please, Tom. Yep, thanks. Corporations in general are limited on the amount of charitable contributions that they are allowed to deduct in any current tax year. They are usually subject to a limitation of 10% of the corporation's taxable income, adjusted for certain items. Under the CARES Act, this limitation has been increased to 25% in order to encourage corporations that have the means to donate to charity to increase their contributions for 2020 by allowing the deduction of these excess contributions. Any contributions that are not allowed to be deducted in any given tax year are carried forward to future tax years and available for deduction if taxable income limitations are met. Also included in this increased limitation is the donation of food inventory by a company. Next, Tom. Now we will move on to the change that may impact the greatest number of businesses in tax year 2020. SBA loans, more specifically the PPP loans that have been forgiven by the SBA or will be forgiven by the SBA, are not included in a business's taxable income as long as the use requirements have been met. However, the IRS has currently ruled that expenses that were paid using the PPP funds are not tax deductible as long as the taxpayer reasonably expects that the loan will be forgiven. This applies to taxpayers that have applied for forgiveness but have yet to receive the forgiveness approval from the SBA, as well as taxpayers that have yet to apply for forgiveness but have identified the expenses that will ultimately qualify forgiveness. Under this current ruling, there could be some adverse tax surprises in 2020 with the disallowed expenses. As Tom mentioned earlier, there is still a chance that Congress will include the deductibility in an upcoming relief bill, but that is obviously to be determined at this point. Next, Tom. Thank you. Another provision in the CARES Act was the inclusion of an economic injury disaster loan, more commonly referred to as the EIDL. These are also loans that were issued by the SBA. However, these loans are not eligible for forgiveness. Expenses paid with the loan proceeds, as well as the interest paid on the loan itself, are both tax deductible. Taxpayers that received the $10,000 EIDL advance/grant are taxed on the grant itself. However, expenses that were paid with this grant are fully tax deductible, netting to a zero tax effect on the taxpayer's return. Next, I'm going to touch upon two available payroll credits that were made via the CARES Act. The first is the Employer Retention Payroll Tax Credit. This is a credit available to businesses who were either forced to suspend operations due to a COVID shutdown or saw more than a 50% drop in any quarter during 2020 compared to the prior year. For eligible employers with 100 or fewer full-time employees, all wages that were paid to these employees qualify for credit. For eligible employers with more than 100 full-time employees, only wages paid to employees who provide non-COVID related services are eligible for credit. The credit applies to the first $10,000 of compensation, including benefits paid to an eligible employee. However, if the business took a PPP loan during the year, then this credit is not available to the business. So, and any business that may want to recoup some payroll tax dollars that did not receive a PPP loan during the year should look into claiming this credit for tax year 2020. Next, please, Tom. Additional payroll tax credits that are available via the CARES Act are credits for paid sick leave and family leave. Tax credits available to eligible employers for required paid sick leave or family leave to an employee who cannot work during COVID-19. The sick leave credit is for paid sick leave to an employee who is quarantined, who is advised to self-quarantine, who has symptoms and is seeking medical advice, or for someone who is caring for someone with COVID-19. The family leave credit is for leave paid to an employee who is caring for a child whose school or facility is closed or whose care provider is unavailable during the COVID-19 pandemic. So this was just another thing put in by Congress to incentivize businesses to pay for sick leave and then recoup some payroll tax dollars on top of it. Last slide, Tom. And the final thing I'm going to touch upon today are just some expiring tax provisions in 2020. As with most tax years, there are a bunch of credits that will be expiring this year. I have listed a few on the screen, but the most prevalent one is the work opportunity credit. This is commonly seen paid to employees who meet certain circumstances, and you can claim a credit based on their situation. There are also various depreciation and expensing provisions expiring this year for things such as motor sports vehicles, film and production equipment. Additionally, there are also various energy provisions. This includes tax credits for plug-in vehicles that are expiring at the end of 2020 and some incentives for building energy efficient buildings throughout the year. There are empowerment and zone incentives that are expiring in 2020. And finally, there are various excise tax provisions that are being changed, specifically related to beer, wine, and spirits and taxes issued on those.
All right, thank you, Stefan, for your insight on these hot provisions. Again, there's so much that happened in 2020. We're just going to try and highlight these for the attendees today. If you do have further questions, please reach out to your Tronconi Segura & Associate tax advisor, and we can help you with these in detail. Right now, I'd like to launch our first polling question. Did you or your business receive one of the following COVID-19 related loans or grants administered by the SBA? We have the Paycheck Protection Program, the Economic Injury Disaster Loan, both, or neither. Stefan, while we're waiting for folks to respond, let me ask you a question. How many of your clients, received one or both of these loans, the PPP and the EIDL?
Tom, I would say at this point, probably 95% of my client base has received a PPP loan for use this year.
Wow, it's pretty substantial.
Yeah.
What are some of the challenges they've experienced, dealing with this loan?
I think the main challenge that they've been experiencing is just keeping up with all the new information coming up, mainly with how to apply for forgiveness for these loans. The rules seem to be ever changing, and a lot of them have come to us for help calculating and filling out the application to send into the SBA for forgiveness.
Okay. Yeah, I know our COVID response team has been busy helping a lot of clients with that, and we're still getting calls and emails every day. And if you do have issues, feel free to reach out. I think I'm going to close the polling question right now and share the results. You can see here, wow, 55% of the respondees have received a PPP loan. A very small number have taken advantage of the EIDL program. It was a bit complicated to do with the SBA, and it took a while. And then some did receive both, and a good third of the audience did get neither of these, which does make sense given the size of some of the clients and whatnot that are on this webinar. So thanks, Stefan. I think at this point now, I am going to hand things over to Lisa Merkel to discuss some of the individual tax provisions that resulted from the pandemic relief legislation that taxpayers need to know as busy season's right around the corner again, Lisa, right?
Yes, it is, Tom. Thanks for the reminder. Good morning, everybody. So today I'll start with some highlights related to charitable deductions for anyone wishing to take advantage of some last-minute 2020 opportunities. The CARES Act offers enhanced tax incentives for making charitable contributions for the 2020 tax year, including an above-the-line deduction for individuals who do not itemize. In general, the itemized charitable deduction for any tax year is limited to a percentage of the taxpayer's adjusted gross income, or AGI. This percentage is determined by the type of organization you donate to and the type of property donated. But for the 2020 tax year, the individuals can claim an unlimited itemized deduction for charitable contributions, which are normally limited to 50%. So back to this above-the-line charitable deduction of $300 amount. Beginning in 2020, and really only for 2020, an individual who does not itemize can deduct up to $300 in charitable contributions made by cash, check, or credit card to qualifying charities. So stock, volunteer hours, or donated goods do not qualify for this. This allows an individual to claim a deduction for a charitable contribution, even if the individual doesn't itemize again. So as you'll see on the slide, the amount that is encircled in red, this will be included on the 2020 form. This is the new line 10B, is a subtraction adjustment from your adjusted gross income. If you donated more than $300 and you're not itemizing, you can't carry that additional amount forward to future tax years or claim as an additional itemized deduction. If you're married filing jointly, your deduction is still limited to $300. It is not doubled to $600 for married filing joint. And as far as we know, this deduction is not allowed for New York State. So certainly if you'd like more information on how you may benefit from the modifications to the charitable contribution limits and this above-the-line deduction, please reach out to your TSA tax advisor. So since I mentioned the standard deduction, the next slide is going to detail out the amounts by filing status, which have all increased for 2020. So these are the amounts of the standard deductions for 2020. They always increase a little bit each year. Okay, next slide. So one other major change to the 1040 is a new line that's been added to page 2 for the recovery rebate credit. Tax credits, unlike deductions, as a refresher, reduce your income tax dollar for dollar. So be sure to take advantage of this credit if you're able to. So thinking back to the economic impact payments received by millions of Americans, the payment you received is not going to be taxable for tax purposes, but it will reduce your recovery rebate credit. So the recovery rebate credit is figured in the same manner as the economic impact payment you may have received in 2020, except your 2020 tax information is used to figure this credit, as opposed to the fact that your economic impact payment might have been based on your 2019 or 2018 information. So you'll be able to take this credit only if you did not receive a payment to begin with, or if your payment was less than $1,200 for a single person, or $2,400 for a married filing joint, plus $500 for each qualifying child you had in 2020. If you don't qualify for this credit, therefore, if both of the following apply. You received a payment of $1,200 or $2,400, and you don't have any qualifying children. So because the economic impact payment you received in 2020 was in advance of this credit or this rebate, then there's a new worksheet that'll provide you with the calculation on whether or not you're going to receive this credit. All right, so I think I'm going to have you move to the next slide. Okay, so another development this year was the student loan payment relief. The CARES Act, among many other things, as we've heard, included a temporary forbearance on payments of certain federal student loans, first until September 30th of 2020, but is now extended until January 31st of 2021. While this forbearance might not be the best answer for everyone, it certainly can come in handy if cash flow or loss of wages became an issue during the pandemic. Basically, the impact here is that federal student loans have been automatically placed in forbearance so that you won't be charged anything on your loan until February 1st of 2021, but you are still able to keep paying on them if you want. Thanks to the CARES Act, there's also a 0% interest rate for all student loans, so any payments you make go straight towards the principal and your loan won't grow in interest. If you need help determining if your loan is eligible for this special treatment, feel free to reach out to us. Okay. Next, we have the RMD waiver, the required minimum distribution waiver. Retirement plan changes have been a very frequent topic in legislation since the passage of the Secure Act passed last December and the CARES Act earlier this year. First, the Secure Act changed the start date of the required minimum distributions to age 72 from age 70 and a half. This means the tax year after the account owner turns 72, the first RMD must be taken by April 1st and then by December 31st in all subsequent years. With the passage of the CARES Act this year came a temporary waiver of RMDs for most retirement accounts. The RMD changes for calendar year 2020 only and applies to individuals who have already been taking RMDs or those who would have taken their first RMD in 2020. The temporary waiver applies to all individuals who were subject to an RMD requirement in 2020, not just those who may have been negatively impacted by the pandemic. If your RMD has not been taken for 2020, then a Roth conversion is something you may want to consider. We've seen many clients who are weighing the possibility of tax rates increasing after 2020 and want to bring a portion of additional income into this year via the Roth conversion. So we can certainly help you with that if you have any questions about how that works. Okay, switching gears a little bit, we're on to the next slide, which is with regard to an Affordable Care Act update. So for anyone listening today who is part of a company with 50 or more full-time employees, including full-time equivalents, your business may be subject to the employer mandate of the Affordable Care Act. The ACA has been in the news a lot this year, and whether or not certain components of it are constitutional. There are still reporting requirements that are still in effect for the 2020 year for these larger employers. Your HR department should ensure that reporting mechanisms are in place to file the Form 1095 with the IRS and issuing them to full-time employees. We do assist several businesses with these forms, issuing them to employees and e-filing with the IRS. So we'd be happy to answer any questions you have in this area. There's also a lot of new state mandates this year, and these states are listed here in addition to Washington, D.C. So please know that if your company has employees working in these states and you are required to file 1095s, they also have to be filed with these states. The deadlines to file these forms are going to be March 2nd to issue them to employees and March 31st to file with the IRS electronically. Okay, that's all I have. Thanks, Tom.
Lisa, quick question for you. As we're waiting for the attendees to finish up with the poll, in addition to this increased tax burden, are we going to see a lot of changes on tax form that's going to complicate, increase the taxpayers' administrative burden as well?
Well, honestly, nothing really compares to the tax form changes that took place after the Tax Cuts and Jobs Act was released. So while there are always some minor tweaks to the forms, nothing really, again, can compare to that where we had a very different looking 1040 as well as all of the supplemental schedules. So no, I would say nothing is going to be too administratively burdensome this coming filing season.
Oh, that's good. That's good to hear. Let me see, let's close up our poll here. We've had 91% response, and according to the results, 2/3 of our respondees have indicated they expect their tax burden to increase in 2021, And I think that's likely. May not necessarily be on the federal side, but definitely state and local. Someone has to pay for all the programs, the unemployment. So I think we can expect some increased taxes in 2021 and future years to pay for all this as it happened this year. All right, let's see. Let's move on to our next section. Diane, I'm going to turn to you for some guidance here. What are some of the issues we're going to be addressing with clients related to 2020? What kinds of documentation are we going to need from them, from businesses, individuals related to some of these provisions that Stefan and Lisa talked about?
Hi, Tom. Thank you. Yeah, there are several COVID-19 relief programs, as Stefan mentioned, that apply to businesses primarily, and I'm going to talk about those. So if you have taken any of these relief programs, they will affect the preparation of your tax returns. And the four primary COVID-19 relief programs are the Paycheck Protection Program, PPP, the Economic Injury Disaster Loan, EIDL, or the grant, the employer tax credits, and the payroll tax deferral. So if we go to the next slide, each of these COVID-19 relief programs provide their own unique benefits and therefore have different treatments for accounting and tax purposes. So as a result, there will be additional information needed in the preparation of your 2020 tax returns. The initial starting point in tax return preparation starts with the client accounting records, which on a basic level consists of the client trial balance and related reports of the balance sheet and profit and loss statement. So therefore, it's imperative that the client account balances accurately reflect the proceeds or other benefits received from these relief programs accurately. And also, if you have taken advantage of any of these benefits, note that they are subject to audit for 6 years. So all supporting documentation should be maintained for 6 years. And we recommend that you pull this together now rather than later in case of an audit. You don't want to go trying to find all these documents years later. And if we go to the next slide, we'll start providing some information on the accounting and tax treatment of these relief programs and what supporting information should be provided to your tax preparers. So we're starting with the PPP program. And if you have received PPP funds, those are treated as a loan until forgiven. So if you have received or expect to receive loan forgiveness, at that point, it becomes forgiven. It is recorded as revenue for accounting purposes. It is not treated as taxable income on the tax return. However, as it stands now, you are not able to deduct those expenses that are forgiven with those PPP funds. As Stefan mentioned earlier, with the current stimulus talks, they may change that. So let's hope they do, and we'll find out soon about that. So if you have received the PPP loan or forgiveness, what you will want to provide to your tax preparer so that it can be reported properly on your tax return is the PPP loan forgiveness application with the identified expenses, the PPP loan forgiveness approval, and then you'll want to ensure that your accounting records properly report these PPP proceeds as either loan or revenue. And then in addition, as it stands now, as mentioned, you cannot deduct those expenses that are forgiven. So you will need to identify where those are in your accounting records so that they are not deducted on your tax return. So now if we move to the next slide, we'll talk about the EIDL grant and loan. So the grant, which was the advance from EIDL, it is treated as revenue for accounting and tax purposes. However, if you receive the grant, you need to coordinate that with your PPP forgiveness because your PPP forgiveness is reduced by any amount of the EIDL grant received. And again, if you receive the loan, make sure it's recorded as a loan in your accounting records. And if there's any interest paid or accrued, make sure that is reported properly as well. For the items to provide for your tax preparer, we would need a copy of the EIDL loan document showing the amount of the loan, the interest rate, and the repayment terms so that that can be reflected properly. And again, you do want to make sure that your accounting records match what that loan document says and that it is all reported properly as either a loan or revenue in your accounting records. So if we go on to the next slide, we will talk about the employee retention credit. And the employee retention credit is treated as revenue. It is money received back for claimed on the quarterly 941 tax return. And because it is recorded on the payroll reports, how it is treated for tax purposes, it isn't revenue, but you have to reduce your wage deduction on your tax return for the amount of the credit. So in order to have your tax return prepared and properly reflect this benefit, it would be best to provide your preparer with the federal quarterly payroll reports, Form 941, for any quarters in which you took the credits. If you received an advance payment of these credits, you would want to provide the Form 7200. And again, you need to ensure that your accounting records properly reflect these as either credits as revenue or receivable if you hadn't received them by the end of December 2020. And if we move to the next slide, the next credit we will talk about are the essentially the paid sick and family leave credits. These are calculated and claimed similarly to the employee retention credits. They are treated as revenue for accounting and tax purposes. So that's essentially the treatment on there. So make sure it is treated as revenue. And again, like the prior credits, you would claim them on the 941, and you would want to provide all the quarterly 941s in which the credits were claimed. And if you received an advance on those credits, again, you would need the Form 7200. And then you want to make sure that those credits were received as revenue or receivable in your books. And the last item we will go through is a deferral of payroll taxes. So this isn't a credit, and it was just intended to help with cash flow. So all payroll taxes are still payable. However, they are not due until the end of 2021 and 2022. So therefore, to properly reflect this deferral, the calculated payroll taxes expense and liability for deferred tax, they both need to be recorded in full. You haven't paid these taxes in 2020, so there's no cash outflow, but you need to ensure that you record the full expense and the full liability, even though these were not paid yet. So if you did elect to defer the payroll taxes, again, this was also reported on federal quarterly payroll reports, Form 941. So all Forms 941 with a deferral elected should be provided to your tax preparer so they can ensure the payroll tax expense and liability balance for deferred taxes agrees with the totals per Form 941 as of the end of 2020. So as you can see, these were four very different relief programs, and they all have different treatments for accounting and tax purposes. So if you have taken advantage of any of these, please make sure you provide all the required information to your tax preparer so that everything can be reflected properly. And that concludes the business piece of preparing for your 2020 taxes. So I'll pass it back to Lisa to go over the individual.
All right, thanks, Diane. All right, so the IRS is encouraging taxpayers to be proactive and take some steps now to make tax filing easier in 2021. They've been pretty aggressive on social media with a series of posts about things that taxpayers can do now. So anyone out there that is lucky enough to follow the IRS on social media, you've probably seen these posts, but they've been very informative. So we've talked about the charitable deduction. You'll want to gather up any receipts that you have for charitable donations to claim that new above the line $300 deduction if you're not itemizing. So that's something new that you might want to be gathering up this year. We will be talking about the economic impact payment in just a moment. And unemployment, but you're going to want to be on the lookout for W-2s, of course, 1099s arriving in the new year. If you earned and received interest on a delayed federal or state tax refund over $10, you'll receive a 1099 for that as well. That interest is taxable, so include that 1099 with your tax documents as well. Okay, so next slide, Tom, I'm going to talk about the the tax impact and documents related to the economic impact payment. Back in April or so, when these payments started to arrive and get directly deposited, they were preceded by this Notice 1444 signed by the President. Here's an example of what that looks like. If you can possibly locate this document, that would be helpful to your tax preparer to prove out the amount of the payment that you received or was directly deposited. It provides information about the payment, how it was made, and how to report any payment that wasn't received. If you can't find this document, which might be the case with a lot of folks, just anything that you can provide to substantiate your economic impact payment would be helpful so that we can go ahead and prepare that worksheet related to the recovery rebate credit. Okay, so unemployment. Unfortunately, a wide variety of very widely used benefit for so many Americans this year. These payments are taxable for federal and state purposes. If you received unemployment benefits, be on the lookout for a 1099, which will report your 2020 benefits and any federal and state withholding on those payments. Your 1099 will be available after January 9th on the New York State Unemployment Portal, so you can go online and download that yourself. Lastly, we have the office and home deduction, which we're getting a lot of questions about. This is a helpful flow chart to help you determine for yourself if you might be able to take advantage of this deduction. So with so many more Americans working at home, a lot of taxpayers are wondering if they can claim a home office deduction on their 2020 tax return. So here's just a few reminders about this deduction. Employees of businesses are not eligible to claim the home office deduction. If you are a business, a self-employed individual, or even maybe a partner in a partnership or other flow through, you must have a portion of your home exclusively used for conducting business on a regular basis. It might be for someone who conducts business outside of your home and also uses their home to conduct business, invoicing, pay bills, do any type of bookkeeping, what have you, make calls or meetings. If you are a sole proprietor and file Schedule C for your business, chances are this deduction is for you. And if you either own a home or a rent, you can take this deduction in many cases. So please bring these questions to your tax professional so that we can help you take advantage of this deduction. All right, that's all I have. Thank you.
All right, thank you, Diane and Lisa, for your insight on this. I believe we're planning to do another webinar sometime early next year, if I'm correct. That's going to be a more in-depth look into preparing our clients for filing their 2020 tax returns. So watch for some emails and posts on our website and social media channels for more details. Diane, as I launch our third polling question here, which of the following COVID-19 tax changes was most impactful to you or your business? A question came to my mind about some of these employer tax credits. If I was a business owner who was just inundated, running his business, dealing with all the COVID restrictions this year, and I wasn't thinking about the employee retention credit or deferring my payroll taxes, can I still take advantage of these provisions as I sit here less than 2 weeks left in 2020?
Yes, if you didn't take advantage of these credits, you can amend your quarterly 941 tax returns and still take those credits as long as you were eligible.
Oh, that's great. So I do have an opportunity to go back. I mean, obviously, I can't take the employee retention credit if I already received a PPP loan, but I can still do the deferral of tax or even the retention credit if I did not get a PPP loan and my business meets the qualifications.
Correct.
Excellent. Let's take a look at the responses here as we're pretty close to full. Let me give it another 10 seconds or so. All right, I'm going to close the poll and share the results with you. It looks like it was a pretty even split among the folks that did take advantage of these credits. About 60% of the respondents didn't take advantage of any of these. It could be the case since we had a lot of people did take the Paycheck Protection Program loan, but a pretty decent split. Some people did take the employee retention credit, deferred their payroll tax, and took advantage of the credits for the emergency paid sick leave or family leave. Again, if you have any questions about these programs, please call or email Diane or any of today's presenters or your Tronconi-Segura tax advisor for assistance. We hate to see you forego any benefit that can help you or your business during this year. Now, sitting here patiently waiting for his chance to speak has been my partner, John Callahan. John, it's been a crazy year to say the least, and on top of things, we've had a presidential election to cap it off. It's been much talked about by many financial commentators and articles and reports from all the various think tanks out there. What can you tell us about President-elect Biden's tax plan?
Well, hey, thank you, Tom, and good morning, everybody. As Tom mentioned, I'm going to be talking about President-elect Joe Biden's tax plan. And I really need to start off with an obvious disclaimer. Everything that I'm going to be talking about are strictly ideas that have been proposed by Joe Biden. Nothing has been voted on. Nothing has been passed into law. As a matter of fact, there are still 2 open seats in the Senate, and hopefully we'll find out in the next month or so how those seats go. But one thing we do know is those seats are going to determine who controls the Senate. So, you know, with such a thin margin in not only the Senate but also the House, it's really difficult to project how things are going to go. So honestly, it might be a little too early to put tax planning strategies into place based on these new proposed rules. But what I'm going to do is I'm going to go through a few of these changes and or proposed changes, and we'll get started here. You know, in general, we do know that it's expected that you know, President-elect Joe Biden is going to increase taxes. He wants to increase taxes on corporations as well as individuals making more than $400,000. He plans to do this in a variety of different ways. He wants to increase the individual income tax rate. He wants to increase the capital gains rates, payroll tax rates. He also wants to increase corporate income tax rates as well as reintroducing a corporate minimum tax. Now, I know it will depend on, you know, what parts of these plans are passed, but it has been reported that, you know, the Biden plan could raise tax revenues by, you know, 3.3 trillion, you know, over the next decade. And, you know, some people may say that, you know, that's a lot of tax. Others may think it's a, you know, a great start. You know, all I know is there's going to have to be probably some type of tax increases to help pay for, you know, almost $6 trillion that we've spent just this past year on economic relief. Next slide, Tom. All right, so let's get into you know, some of the details here. You know, as I said, the Biden plan wants to increase the individual income tax rates, or at least the highest individual income tax rate. And this is going to be for incomes, taxable incomes over $400,000. Now, the current rate is 37%, and this proposal would increase the rate to 39.6%. Now, what we don't know is, you know, what's going to happen with the other tax rates and the other tax brackets. You know, does he plan to, does the Biden plan plan to eliminate some of these brackets? You know, currently the top tax bracket for a single taxpayer starts at approximately $500,000. You know, would this new 39.6% rate begin there, or would it start at $400,000? We're really not sure about that. Another thing that the Biden plan would like to do is increase the tax on long-term capital gains and qualified dividends. And this would be for taxpayers with income over $1 million. Now, currently the highest tax rate for long-term capital gains and qualified dividends is 20%. The Biden plan would like to nearly double that to 39.6%. Now, this could be a pretty big deal for some investors. However, it may not have as big of an impact as, you know, one might expect. You know, keep in mind, for the most part, investors do control when they realize long-term capital gains. So if they don't like this rate, they could, in some cases, just hold on to their assets, not realize the gains, and not pay any tax at all. So this might even have a negative impact on the amount of revenue raised. The next point is about the P's limitation. Now, this is something that was in law a few years back. The Biden plan wants to restore the P's limitation on itemized deductions for taxpayers that have taxable income over $400,000. And essentially, the P's limitation was just a phase out of certain itemized deductions. The phase out began once the taxpayer's adjusted gross income, exceeded a certain threshold. And the threshold did vary over the years, but it was, approximated $250,000. So, the Biden plan doesn't want this to come into play until income is $400,000. So at least the threshold, the income threshold, is a little bit higher. And I'm not really sure the details of this, but under the old rules, the phase out, occurred, as I said, as your adjusted gross income, exceeded $250,000. And in the reduction of your itemized deductions was 3% times the excess. So if your adjusted gross income was $350,000, that was $100,000 over the threshold. So 3% of that was, $3,000. So your itemized deductions for that year would have been reduced by $3,000. The next point here is also related to itemized deductions. And what the Biden plan wants to do is he wants to cap the tax benefit on itemized deductions to 28% for people earning more than $400,000. And just to take a step back, when we prepare our individual income tax returns, we total up all of our income. We subtract out our itemized deductions to determine our taxable income. So really, our itemized deductions are lowering the tax rates that we are in. So if you are in the top tax bracket of 37%, any additional itemized deductions are going to be saving you 37%. So if you have a charitable contribution of $100, if you make that contribution, the tax benefit for you is going to be $37. Now, if somebody was in the 15% tax bracket, that same $100 contribution is only going to save them $15. So this is just kind of a way to try to equalize the tax benefits, for all taxpayers, regardless of what tax bracket they're in. Next slide, Tom. This next point kind of has the same concept of what we just discussed about equalizing the tax benefits. And it relates to traditional retirement accounts like 401ks and individual retirement accounts. The Biden plan wants to, remove the normal deduction that we take for these items and, replace it with a tax credit. So again, if you think about this, you have a W-2 and you make $100,000, that is going to be taxable to you. If you make a 401k contribution of $10,000, only $90,000 is reported on your W-2. So that whole $10,000 401k contribution is going to give you a benefit, of your top tax bracket of, let's say, 37%. And then the same thing happens at the lower rates as well. You only get a 15% tax benefit. So what the Biden plan wants to do is they want to get rid of this deduction and they want to treat it as a tax credit. So essentially it'll equalize the tax benefits. Another big change here would be a phase out of qualified business income deductions. And this would phase in for people with taxable income over $400,000. This is going to be a big issue for our tax clients that are shareholders in S corporations or partners in partnerships. Essentially, the QBI deduction is a 20% deduction for any qualified business income that you have. So, there's plenty of rules and that you have to follow to to get this deduction. But essentially, if you have qualified business income of $100,000, your 20% deduction or $20,000 means you're only being taxed on $80,000. So, you know, as the QBI increases, obviously the benefit of this is much greater. The next point here talks about estate tax, and essentially what the Biden plan wants to do is they want to reduce the lifetime exemption to $3.5 million. They want to increase the tax rate on estates to 45%, and they want to eliminate the step up in basis. And so this is really a big deal as well. You know, the current lifetime exclusion is a little over $11 million, $11,580, and the current tax rate is 40%. So as by way of example here, if you have an estate worth $10 million, that's currently under the current lifetime exclusion. So there is not a taxable estate and there is no estate tax owed. If this Biden plan is passed, what they want to do is they want to, again, reduce the exemption to $3.5 million. So in this example, you would have a taxable estate of $6.5 million. And at 45%, that's going to result in almost $3 million of estate tax. As I mentioned earlier, they want to eliminate the step up in basis at death. You know, this is a big thing as well, because essentially it's just going to, you know, push capital gains out to the beneficiaries, which under the current rules, they would not exist. So the last bullet point on this page talks about Social Security. He wants to increase Social Security taxes for people earning more than $400,000. Obviously, everyone pays Social Security tax on the first $137,000 of their earned income. The Biden plan wants to have this tax also come into play on incomes over $400,000. Next slide, Tom. And I see we're almost running out of time, so I'm just going to go through these last couple of points real quick. You know, the Biden plan wants to increase corporate income tax rates from 21 to 28%. You know, not a lot of details on this. I assume it's still going to be a flat tax without brackets like it used to be. The Biden plan wants to bring back alternative minimum tax calculation. They want to double the tax on foreign subsidiaries. Right now, there's an effective rate of 10.5%. The Biden plan wants to increase that to 21%. So again, this is the for earned income on the foreign subsidiaries. And then, you know, again, as we're running out of time, I just want to draw your attention to the next couple of slides. There's other potential changes in there for children, you know, or for taxpayers with children, for first-time home buyers. There's other business credits and such. But, you know, if you could look through the slides. If you have any questions, you know, please reach out to us. And at that, I'll send it back to you, Tom.
Thanks, John, and sorry to cut you short there. I know you had a lot of changes and a lot to discuss there. We appreciate the analysis. It's a lot to unpack and consider. And as we come up on 11 o'clock, I just want to ask our last polling question here. When do you expect elements of the Biden tax plan to be approved by Congress? John, what are your thoughts on this?
You know, I got to say that it could be, you know, a couple of those, to be honest with you. You know, it could probably be sometime by the end of next year is probably what I would say. If it doesn't happen then, you know, I would say probably around midterm, because again, we've got a real a thin margin in the House and the Senate. So who knows how it's going to go there. If there was an overwhelming majority in the House and the Senate, I would say probably immediately, but hopefully by the end of 2021, I would imagine.
Okay, thanks. I'm going to close the poll here so we can wrap things up. Looking at the results, I think, you know, a good 80% think it's going to take some time before any of these tax plans get approved, with about 40% at the end of 21 and another 40% at, around the midterm 2 years out. So we will see what happens with that. Thank you, John. I'd like to thank you and Diane and Lisa and Stefan for being with us this morning. It's never easy getting ready for one of these webinars, and I think you all did a great job highlighting and sharing some important tax information with our clients and friends. If you have any questions, please feel free to contact one of the speakers by email or submit a question through our website here. I will also share any questions we received this morning during the webinar with our speakers, and we'll do our best to respond to you as soon as we can. We are planning to present additional tax-related webinars early next year. In addition to the one on preparing to file your 2020 taxes, we're also planning a SALT update webinar close to my heart. Lots of issues there to discuss as we head into the new year. Remember, if you are planning to receive CPE credit for this webinar, you need to complete the survey that will pop up once the webinar ends. A link to the survey will also be provided in a follow-up email that will be sent shortly. So at this point, I want to thank everyone for attending this morning's 2020 Tax Update webinar. We'd like to wish everyone a very happy, healthy, and safe holiday season, and we look forward to working with you in the new year. Thank you.